Talk to me about the liquidity story, because that's what yesterday was about.
Yeah, so let's put it into context, right? It was obviously a really rough day for fixed income. 95% of the fixed income ETFs were down, at least an average of like 3%. It was a very rough day for fixed income. So there's really two things happening, right? There's the price of the ETF, and then there's the underlying basket.
Yep.
So what you end up having here is everyone's trading the ETF. It tends to move ahead of what the actual basket is trading, right? So what you end up seeing that we did yesterday is you have these big discounts in some of these products, right? That's not necessarily a bad thing. It's just it optically looks bad, but it's really just meaning that they're not able to source liquidity from the underlying, right? So everyone's trading the ETF, which just means that that's just moving ahead of what the underlying market is doing. So I think in a time like this, the ETF actually becomes a vehicle that you're turning to for more real-time pricing, where the NAV just tends to be a little bit more laggard in its pricing, right?
NAV being net asset value.
Yeah, exactly.
Yeah, just to be clear.
Yeah.
Vonnie.
Tom, were things as bad as they looked for ETFs? Any particular area under severe stress?
So some area, if you sort of lay it out on the spectrum, only a very few ETFs are trading at very big extreme discounts. And most of those areas were like high yield municipal bonds. And I can sort of see that, that market just tends to be a little bit more fragmented. It's a little bit harder to trade. So, but most of the ETFs, let's say about 40% of the market, traded anywhere from a 1% to a 2% discount. And I think given how aggressive the selling was yesterday, that's actually a pretty good stat.
How are ETFs performing in kind of this world versus, say, mutual funds?
Yeah, and I think there's two things, right? So if a mutual fund investor has to redeem, right, they're faced with the same situation. So let's just say this fund manager has to sell bonds. He's likely going to be selling the most liquid bonds. Where I think that could become an issue is the shareholders that are remaining in that mutual fund are potentially going to be stuck with some very illiquid bonds down the road, right? So I think that the ETF, at least the experience of getting out of the ETF is unique to you. So you might not necessarily like the price, or it might be a little bit of a discount, but at least you're not impacted by the actions of any other shareholders.